Hello everyone, how are you doing today? In this lecture video, we are going to cover chapter number 1 of ACCA exam FM. For the ease of learning, I've divided this chapter into three areas, into three videos. So let's start with the first part. If you come to page number 1 of your lecture notes, first we have got the name of the chapter, that's financial management function. After that, we have got a few definitions. Let's start with the first definition. Financial management involves planning, controlling, and decision making in order to ensure efficient and effective utilization of entities' financial resources. Now, from that definition, we can clearly establish that financial management will be equipping us as financial managers with techniques and tools related to planning, controlling, and decision making. For what? Now, question arises, for what? Well, for the efficient use of financial resources. Firstly, efficiency involves getting more output with the least input. So we will be utilizing financial resources with efficiency, and after that we've got effectiveness, which implies that we achieve the desired task, desired objective of using that fund. So it is the responsibilities of financial managers to use planning, controlling, and decision-making techniques to utilize the financial resources of an entity in an efficient and effective manner. This is best understood if I put that in a chart. First, we have got financial management. Now it will be equipping us with planning, controlling, and decision-making tools. So let's write that down. Planning, controlling, and decision-making. And the reason why it is equipping us with these techniques so that we may utilize financial resources efficiently and effectively. So that's what financial management is in terms of definition. Now this could be more understandable if we compare it with the definitions provided in the lecture notes of financial accounting and management accounting. So let's have a look at them. The next definition that comes is of financial accounting. Now financial accounting is concerned with preparation of financial statements and reporting of financial position and performance. It's simply a recording exercises using the accountancy system. We start with recording area, that's from sales day book to summarizing ledgers and then eventually preparing the financial statements. So financial accounting is mainly concerned with the recording, summarizing, and preparation of financial data. It has nothing to do with the management of finances or management of financial resources. The scope of these two fields is quite different. Let's put that in our chart as well. Financial accounting is basically a recording and summarizing exercise, that is from sales day book to preparation of financial statements. This is the scope of financial accounting. Now let's come on towards the next definition, that is of management accounting. Now management accounting is mainly concerned with providing information to managers internally in the organization so that they can plan, control, and are able to take informed business decisions. The planning, controlling, decision-making part is the overlapping part of with financial management. However, the scope of these two these two fields is quite different from each other. Management accounting is more relevant to the costing and performance management side, where managers get information from the financial accounting system for the utilization towards the costing and performance management. It is a source of through management accounting, managers get the information from the accounting system and use it for management internally in the organization. So let's put that also in our chart. We have got management accounting now. It's concerned with provision of information to managers so that they can plan, control, and take informed decisions. So if we compare financial accounting and management accounting with financial management, you can see a difference very clearly. Financial management is the whole scope of financial management is concerned with management of finances. The financial accounting scope is concerned with the recording and summarizing, whereas management accounting is concerned with the management of costing and performance management areas internally to the organization. The main purpose is to provide information to the manager so that they can plan, control, and take informed decisions. So that's the whole definition area of financial management. Now let's move on towards the elements of financial management. Now this is a very interesting area, and if you are studying financial management for the first time, I suggest that you pay very close attention to it, because if you are learning financial management and you are completely blank about it, then this is the first area you need to have on the page 1 of your mind. So as from the definition, we have learned that it will be equipping us with planning, controlling, and decision-making tools. The question arises, why planning? Means why we need financial management techniques for planning purposes, why we need financial controlling management thing for financial controlling, why we need, in what perspective we need to take decisions. So these are the questions that comes up immediately in your mind. So let's start with that and answer each of them. Financial planning. Management needs to make sure that sufficient funding is available in order to meet business short and long-term financial needs. Now, if you are a financial manager in a company, it's obvious that all the burden of management of finances falls on your shoulders. You need, for example, your management decide, the senior management of the company decide that it wants to invest in some fund 3 years from now in a particular XYZ country on a dairy project. So the question arises, as a finance manager, what you should do now? Now you have foreseen that this event will come. It's your responsibility to start arranging for the funds from day 1, that's from now. At the same time, keeping the current operations running smoothly in terms of finance means if the liabilities becomes due, you have to pay for them. The company will need to pay for them. So sufficient funding needs to be available within the company's bank account right now, so that they may set up their current liabilities. The financial managers needs to assess the short and long-term financial needs of the business and arrange their fundings accordingly. For this purposes, we need some planning tools and techniques of how we can do that. Perhaps it's a big company, it can finance a whole project with its own retained earnings, or perhaps it's not that big of a company and it needs to finance the project with a bank loan or a loan notes issue. In case of a bank loan or a loan note issue, it's quite obvious that it needs to pay the finance cost, the interest payments for getting those funds and putting it in the project. So this is obviously this will further decrease the net profit being estimated from the investment in return. So that's why we have to have a thorough planning. If a loan needs to be established 3 years from now, it's obvious that the covenants and the conditions of those loans can be anticipated and arranged for from now only. So financial managers need to have a clear sight in terms of planning, short and long term. After that, we have got financial control. Now, management needs to focus on financial controlling to ensure that financially business is meeting its objectives. It is important that the management have some sort of control mechanism over the finances so that short and long term objectives of the business is meeting. We will be covering corporate objectives and financial objectives in this video only towards the end. For now, you need to know that management, all companies have financial objectives, and for that financial managers are responsible for. And in order to achieve those objectives, they need to have some sort of controlling mechanism. For example, if it's a policy of a company to invest surplus available fund in a short-term investment, it's a responsibility of the financial manager to assess whether they are reaching the upper level so that we can invest them, or whether they are depleting to a lower level, so we may need to defreeze our investments if we have already invested in a short-term instrument, and bring it to the company with a bank account so that the current liabilities can be set off. After that, we have got financial decision making. Now, this is perhaps the most important area of this video. Pay very close attention. If you are learning financial management first time, this is the page 1, then this needs to be on your page 1 on your mind, that what financial management does actually decide in between. So let's start with that. It's best understood if I put that in a chart. Now we are learning about the trio of financial management, and that is financing, investment, and dividend. Now this is the triangle of financial management. It is the responsibility of financial managers to have a balance in all these 3 areas. It is the responsibilities of financial manager to balance between these three areas. So this needs to be this is the scope of financial managers and financial management. Let's read out from the notes. Financial decision making relates to investment, financing, and dividend distribution decisions. The link between these three are follows. We can understand this with the links, with the examples given below. Decisions need to be made relating to investments which require financing. Such financing can come from internal retained profits, selling new shares, or obtaining bank loans. Now, let's suppose there is a company, a big company. We call it the big company because it's a big, and it wants to invest in a dairy project in XYZ country. So the big company needs financing. For that, for the purpose of investment, as you can see, for the purpose of investment, it needs financing. So what it can do, it can either use equity funding, that is issue new shares or use their own retained profits, or it can use debt financing. Now debt financing involves bank loans and loan notes, so that's a very important area. If the bank loan notes if loan notes are issued and a bank loan is obtained, so it's quite obvious that finance costs will become due, which will seriously have a negative effect on the net profit. And this is again which we are being told in the second part. Such options of financing, which I've just told you, issuing shares from equity or obtaining bank loan, needs to be considered thoroughly in order to make appropriate financing decisions. If a bank loan is being obtained, it's obvious that the return which is expected from the investment will be low, because now the business has to pay for the finance being obtained in the form of interest payments, or perhaps it can look at the overall profitability of the project. If the project is giving us a return of 10% per annum, and the same percentage, that is 10% per annum, being offered by our bank, then why go with all the hustle of investment in a dairy project and the risk associated with it? We can simply put the money in the bank and get the rate of return. So it's important that we decide between the different decisions thoroughly. It's important that we consider each element thoroughly before initiating any project. However, using internal retained profit as a source of finance will affect the distribution of dividends to shareholders. Such an adverse impact can make shareholders upset, resulting withdrawals of current investments or withholding of future investments. A balance in all three needs to be maintained. From this link, you can clearly establish that there will be a negative consequences if the company decides to finance this project. It's obvious that if the company decides to finance this project via equity, this will reduce dividends. It's obvious that the dividends will be reduced. There will be less cash available by the company to give in the form of dividend to shareholders. So what the impact will be, if the shareholders are not happy, they will reduce their investment. That is by shareholders, which in turn can reduce our financing for the operation and for the new project. So we have to keep on growing. For that we need investment in new projects. For that we need financing, and for that we have to either issue a shares or borrow a loan. If it's from shareholders, obviously we need to keep them happy by providing them the dividend. So it's a kind of hectic job. We need to keep a balance in all three of them. We need to keep every aspect of the company running. We have to keep the shareholders happy, we have to make the investments, and we have to arrange for the financing to meet the short and long term liabilities of the business. Now, after that, if we come back to our notes, the next topic coming over here is corporate strategy. Now, all businesses have corporate strategies. Let's read out loud. It's concerned with the overall purpose and the scope of the organization and how value will be added to the different parts of the organization. Now, corporate strategy deals with the overall purpose, the reason why company exists, and the scope, the limitation within which it operates of the organization, and what are the plans, what will be the things it will be conducting to generate those values which will meet its purpose and scope. So that's the thing which the board normally sets. The corporate strategy, for example, the corporate strategy of Nestle perhaps is to offer quality products across the globe. So that will be their purpose, and they will not be indulging in any other. For example, they will not be moving into textile, or they, because this not that would not be in their scope. After that, we have got and how value will be driven, perhaps to offer quality service across the globe. That's how they will add value towards the company. So if that's the corporate strategy, in order to achieve that strategy, there are corporate objectives set by every company. Now, I've included there are certain corporate objectives over here from the course. These are the basic corporate objectives which are being incorporated by most of the companies nowadays. So let's look at them. Firstly, objectives are relevant to the organization as a whole, relating to the key factors for business success. They are the key factors through which a business succeeds. So that's the thing. That's why their businesses strive for to achieve the corporate objectives, because that's what makes them successful. They are the key, you can say, key performance indicators. If these are going great, the business is moving towards the right direction. First, we have got profitability. Like all businesses, all businesses exist to make profit. So the profitability is the first objective. Then we have got market share. As the business grows, it always wants to have a certain market share in the market, so that it can assure its presence and assure its existence in the future. After that, we have got growth. Now, all businesses needs to show a steady growth if it wants to borrow money from the shareholder. If it wants to shareholders to invest in the company, it needs to show a certain level of growth year. All businesses nearly set their annual growth rate through which they strive to achieve in the year. Cash flows, sufficient cash flows needs to be there in the premises to meet the short-term liabilities, as well as there will be certain savings needs to be there to finance the long-term investment opportunities. After that, we've got customer satisfaction. This has now it used to be a marketing objective, but now it has climbed up the ladder towards a corporate objective nowadays, because it's most important in this area. Because of the social media, things can get really ugly really fast. For that, we need to keep customers satisfied and help them beyond our capabilities. After that, we have got quality of our products. Now, like everything else, all companies around the world now need to strive to bring quality products to the market, so that their name have a good value in the perspective of the customers. Then we have got industrial relations. Nowadays, it's best if we make good corporate relationships with our rivals, and with our customers and suppliers. For example, within the textile industry, it's best to have a good relation with other textile companies, so when opportunity arises and observed by one, it can share and benefit, so the whole industry can benefit from it, resulting in extra benefit to all of the companies. After that, we've got financial objectives and non-financial objectives. So firstly, we have got corporate strategy. Then we have got corporate objectives. Now, in order to achieve those corporate objectives, a company sets further objectives. For example, there are HR objectives. Then we have got marketing. Then we have got financial objectives. Then we have non-financial objective. Now, the scope of FM covers these two, so we will be learning about these two from the notes. Financial objectives. Shareholders' wealth maximization. It's obvious that the shareholders invest funds so that we can increase their wealth. So a steady profit, steady growth in future prospects will ensure that our shares are perceived by investors in good books, which will increase our share price, which in turn will make shareholders happy. And at the same time, a steady growth in profit means the more dividend will be available for them at the year end. So shareholders in wealth maximization is one of the financial objectives of financial managers. After that, we have profit maximization. It is the responsibility of financial managers to maximize the company's overall profitability. We can increase that by investing surplus funds in short-term investment and surplus funds which are available for the long term. We can invest that also and attain a good return, thereby increasing the company's profitability via other income source. At the same time, we can reduce finance for admin and finance costs by the company by good management, good planning, and good control techniques. After that, we've got steady growth in EPS. EPS stands for earnings per share. Each shareholder will be happy if their earnings per share increases steadily over the year. So a steady growth in EPS year by year, that is a steady growth in profit year by year, will be a good sign, and shareholders love that. Then we got restricted gearing. Gearing involves financing companies with debt. It's best if the company keeps its gearing level low, so that it otherwise a lot of control over the company's profit gets to the providers of the finance in terms of debt. As we all know, debt is the priority one in terms of liquidation, so they get the priority over everything. If their company is financed with debt, their finance cost, the interest payment, will be deducted first before arriving at the profits. So it's best if we keep the gearing level low. Target profit retentions. Target profit retention implies that certain amount of profit needs to be retained by the company itself so that it can operate effectively and so that it can invest in future investments. So if a profit needs to achieve a certain level so that we can have that target profit retention figure in our accounts, we can withhold that much amount of money, because we cannot reduce, as I've just told you, we cannot reduce the dividend. That's the amount which we have to pay constantly to our shareholders. We cannot reduce that. However, what we can do is increase our profits to such a level that after issuing the dividends, we have enough profits to finance our long-term projects. Then we got target operating profitability. Means target operating profitability means net profits being. But this can only be achieved if we keep our finance costs, admin costs, and salary costs low. Finance costs is in the control of financial managers. We can achieve that by lowering gearing. Now we have got non-financial objectives. In today's world, it's equally important that we pay close attention to non-financial objectives as well, because they also drive value to the organizations. The welfare of employees. Company needs to keep their employees happy in the terms of salaries and benefits. Then we got welfare of management. We have to keep the management also happy in terms of salary, benefits, and options of shares. Plus we give them vacations and protect them, so that if they are happy, obviously if the directors are happy, if the senior management is happy, the company will run great. And the company also wants to keep good management to itself so that it continues to progress. After that, got bigger provision for services. It's a non-financial objective. However, it's best if we provide services towards the society. Perhaps we can fund and scholarship program. So this will create a goodwill in the perspective of the customer and in the perspective of society as a whole. After that, we got fulfillment of responsibility towards customers. It's best if we keep our responsibilities towards the customers satisfied. In today's world, it's very important to keep the customers happy. Otherwise, negative publicity can reach one part of the world from other in just a matter of a share button. So it's important to keep the customers happy. We need to go beyond our capabilities to keep the customers happy. Then fulfillment of responsibility towards the supplier is the fifth point. which indicates that our suppliers' basic requirement from the company is that if they are paid in full in the due time, plus they get constant contracts from us. Obviously, they also want to continue their business with us. We need to provide these two things to the suppliers in order to keep them happy. After that, we got welfare of the society whole. We got CSR, stands for corporate social responsibility, which is now a part of every financial statements across the world. And we need to have a financial manager's responsibility is to finance these projects as well to keep the company in the good books of the society. We can do this by reducing pollution from the factories. We can do this by achieving health and safety standards. We can also do that by giving a scholarship to the students so that it will create a good impact on the society, at the same time creating goodwill for the company. The last topic of this video is shareholders' objectives. Now, shareholders' objectives involve that certain shareholders require different things from a company, and this is their objective which our company must meet. Shareholders are the first stakeholders excuse me, wants to maximize their wealth. What we can do here is to increase our profit steadily so that we can keep this objective of the shareholders satisfied. After that, we got trade payables. Objective is being paid in full amount in due date. As I've just told you, short-term suppliers' objective is to keep to get paid on time from their customer, that is our company. After that, we got long-term payables. Mostly involve bank loans, so that they want their finance costs being paid on time. At the same time, they want their principal to be paid steadily, and this can only be achieved if the company is profitable for the foreseeable future. After that, we've got employees. Now, employees will only be satisfied if they get good salary, good benefits, and career growth. So, company needs to provide these to their employees in order to meet their objectives. After that, we got government objectives. Now, government objectives is basically based on politics and economic terms. If we fall on that economic front in which the government wants to see flourishes, so it's a very well thing for the company. We will get grants and tax exemption. However, if we fall in the area where the country is seeing sufficient growth, so we will be paying taxes to the government, as the government will be withdrawing funds from that particular area of the industry to finance that area which is underprivileged now. So their objectives from the company is mainly on economic terms and political terms. So they achieve this via taxation, via legislation. They can put a restriction on certain areas, and on health and safety provision of through provision of grants, which I've just told you. After that, we have got management wants to maximize their rewards paid to them in salaries and benefits. Senior management will only be happy if they get their profits increased, if they get their salary increased, their benefits increased. The best way to keep them happy at the same time, the companies can offer them shares, so that when they increase their performances, they will also get the share price will increase, and they can simply get that amount right then and there if they sell their shares. So a lot of things needs to be there for the senior management to keep them happy, because company always wants to keep their senior directors and management happy if it continues to progress. So let's keep it till here. In the next video we'll be covering about ratio analysis. So do watch that also.